Hello to everyone watching this, but a special warm welcome to those of you who have perhaps just embarked on a new career and are new to the world of personal finance. So today we're going to look at Pam. We're going to see whether we can help her get her financial ducks in a row. You might be able to relate to her. She is 23 years old. She has just recently started a new office job. She receives 12,000 Rand net into her bank account. This is after taxes, a compulsory retirement annuity contribution, and a medical scheme contribution. She lives with her parents, but she is considering relocating. She's currently unmarried without any kids, and having obviously just started working, she hasn't acquired any assets as yet. So Pam is your typical Generation Z individual, very much a dreamer. She's always on social media. She wants to save the world. To be honest, she's not very bothered about future Pam. Future Pam is future Pam's problems. She is very much concerned about current Pam and living in the moment, instant gratification. So during her first week at the office, Pam has a very casual conversation over a cup of coffee in the pause area with one of the older senior guys, Stanley. And in walks very confident Jim. Jim tries to impress Pam a little bit, and he starts talking about all kinds of complex concepts, things that Pam has never heard of in all her life. It completely goes over her head, and to be completely honest, she has never been more bored in all her life. She really just wants to run for the hills, and she cannot get away fast enough. So she thinks about, whenever she thinks about investments or finances, she thinks about this conversation she had out on a client meeting with a colleague of hers about this thing called Bitcoin. And to her, this seems like the way to go. This is way more exciting than anything that Jim mentioned earlier in the kitchen. So once Jim leaves the room, Stanley sees the fear in Pam's eyes, and having made his fair share of financial mistakes in his own life, he reaches out to Pam, and he kind of takes her under his wing, and he just inquires about her first week at the office. Has she had the opportunity to chat to HR about her retirement contributions? Does she know what a retirement annuity is? Does she understand the group life cover that they're members of, and the medical aid? And he basically just offers to guide her, and if there's anything that he can help with, she needs to call on him, basically just offering to be her mentor going forward. So Stanley starts talking about a few concepts, and he emphasizes how important they are, and he talks about and asks about Pam's goals and her dreams and her needs, and he just explains how one needs to distinguish between these points, and how important it is at different stages in your life to prioritize between these. He mentions a few interesting facts that he recently read. He mentions people who write down their goals are 42% more likely to achieve them. 42% of Generation Y are wedged in the sandwich generation. That's when you have both adult and child dependents. Nearly half of South Africans don't have a retirement plan. And then 85% of women manage everyday expenses, but only 23% take the lead when it comes to long-term financial planning. So these points really did resonate with Pam, and she doesn't really want to be part of the stats. She sees herself as a strong, independent woman. However, there are many reasons, often call it excuses. We can all perhaps relate to these, but reasons why she can't save right now. Firstly, she can't afford to save. Living from paycheck to paycheck, there simply isn't anything left at the end of the month to set aside. Family responsibilities, even though she has no kids, she is expected to contribute financially to the family or to family-related expenses from time to time. Being the Gen Z person that she is, future Pam is future Pam's problems. She wants to enjoy her money now while she's still young and she can really appreciate it. And then, of course, thinking back to the conversation she just had with Jim in the kitchen, finances are boring. She doesn't want to think about these things. And then, of course, she acknowledges she has strengths, but finances, money, it's not one of them. She really wouldn't know where to start. So Stanley has this amazing ability to break down complex concepts into simple terms, and this is what he does for Pam. So he explains all the difficult concepts that Jim mentioned earlier in the kitchen, and he breaks it down into simple terms that she can understand, and he explains to her why all of these building blocks do form part of the bigger picture and what role it plays in her life and all of our lives. And he does it in such a way that just makes sense to Pam, and that she really can understand simple terms, as opposed to becoming all technical about everything. So in that moment, something incredible happens, that's really going to change the trajectory of her life going forward and really set her apart from her peers. She suddenly just realizes why it's so important to plan for goals. She realizes why it's so important to take charge of your finances, and she's excited for the new chapter in her life. Without a plan, you plan to fail. And so Stanley helps her. He helps her identify her goals. And this is a role that's often something that a financial advisor can help you with, just identifying it, getting things started. He helps her structure a plan that's tailor-made for her own circumstances, a strategy that she can follow going forward, that addresses her own unique goals and circumstances. So there's three financial goals that Pam decides to prioritize. And all three of these goals are needs that she needs to identify, because after the conversation she had with Stanley, she really does realize how important it is to prioritize. And she knows that there's going to be enough time to plan for her wants and for all the dreams she has. But at this point in her life, she really needs to get control over her needs first, and meet them first. So the first financial goal that she has is getting a place of her own, getting some independence, but also having lived with her parents for a while now, being so dependent on the public transport system has proved to be a little bit of a logistical nightmare to her. So that's definitely one of her first priorities. Secondly, buying a car. Her job does expect her to see clients from time to time, so that is something that she definitely wants to or needs to prioritize. And then, of course, she now realizes the importance of planning for future Pam, and she has heard about the amazing eighth wonder of the world of compound interest and how important it is to start saving while you're young. So she really does want to benefit from that as well. So future Pam has finally also taken priority in Pam's life. Getting started is often the hardest part. I would definitely recommend taking the time, sit down and think about what it is that you need from your life, what do you want for the future, and prioritize. Sometimes it can help to talk to a professional, or perhaps a professional mentor at work, or even a family member, just in terms of qualifying and quantifying your financial needs and your goals. And then work out a budget. Make sure that the budget is affordable and realistic. It really isn't just a tick sheet item. It is something you need to live by, and stick to. That is going to be your compass, your financial compass going forward, and then just stick to the budget. And then often when you live paycheck to paycheck, which is so realistic to so many people, it's very easy to underestimate the impact that your savings can have on the future. You often feel that it's too little to make an impact, but it really does help. Just getting started really just is the biggest part, even if it is small. Then in terms of budgeting, a budget really is just a summary of your inflows minus your outflows and what it is that you have left at the end of the month or whatever period you're looking at. There are many templates available out there. Some of them are very complex, but I personally believe that a simple version is most likely going to increase your likelihood of sticking to it. So create your budget, but find a template, find a structure that works for you. There are also many apps available out there. Some people find it easy to work with the apps. So find a template that works for you and stick to it. In terms of the budget, it's always a nice luxury to perhaps try and stick to the budget before you commit to some of the big ticket items. Sometimes if, for example, you plan on purchasing a car, say it's 3,000 Rand, for example, try try your budget first. See whether you can live without that 3,000 Rand before you end up committing to the purchase. That's always something that helps if you have the luxury to do it. And then can't emphasize it enough, just stick to the budget. So Pam starts off by compiling a budget. Very simple. She writes down her income of 12,000 Rand a month, and then she starts listing her expenses. So she sees what it is that she can afford in terms of the expenses. Firstly, what's important that I want to highlight here is Pam has decided to opt for a debit order when it comes to her investments or her savings. This is a fantastic idea because many people end up deciding that they'll save whatever is left at the end of the month, which is not realistic. You end up not saving anything and you're not in a position to plan for it. So by doing it by means of a debit order, you force the discipline, but you also enable yourself to plan and to stick to the plan. So she decides that she can afford to contribute 500 Rand a month towards her long-term or retirement savings. She decides to allocate 700 Rand a month towards emergency funds or short-term savings. She's heard from Stanley that it's very important to have an emergency fund, and due to the fact that she doesn't have any wiggle room in her cash flow at this point, making provision for anything unforeseen is important. And then in terms of her medium-term savings, Pam knows herself, just as she has dreams now, she's going to have dreams in 3 or 5 years as well. So she decides to start saving towards whatever those dreams might be, whether it's going to be a wedding or a car or a holiday. She has no idea, but she does want to start saving towards that to help out future Pam. In terms of the cell phone contract, she of course wants the fanciest phone there, but she opts for the most affordable smartphone that she can find. And then in terms of the car, she knows she can't afford to buy a car by using cash, so she's going to have to incur some debt with that one, and she can only afford 1,500 Rand per month, and then insurance is 500. At this point, Pam isn't sure whether this is even realistic. The fact is, this is what she can afford, and she will have to go and look for something to see whether it's at all going to be possible for her to meet her goals. And then in terms of the general expenses, Pam realizes that she can allocate 3,000 Rand towards accommodation or rent. And she did look around a little bit, and there are places that she can keep her independence and have a place of her own for this price. But she realizes and decides early on that it's not in an area that she's comfortable with. It's a bit far from work, so she'd much rather opt for a place a little bit closer to work in a nice safe area, and get herself a flatmate, sacrifice some of the independence, but have someone carry the burden with her, the financial burden. And then of course in terms of electricity, very similar. She'll then be paying 50% of the expense and sharing the burden with someone else. She budgets for groceries and petrol, and then of course she needs to live as well. So she makes provision for a spending budget and a clothing budget, which is a bit variable. So that's the thing with some of these items at the bottom, excluding the rent, of course. These items will vary month to month, which is going to mean that you're going to have to try and reduce it as far as possible and keep it under control. And that is one of the reasons why your emergency fund will end up being very, very important, to be able to absorb anything that ends up not being according to or happening according to plan. She actually has a surplus. I don't think you can see it on this picture with the camera, but she ends up having a surplus of 100 Rand, which is fantastic. So the idea with this budget is just to show that she can reach her goals. It's going to be a tough time, but she's going to have, if she has the discipline to stick to this budget, she's definitely going to reap the rewards later on in life. So in terms of her retirement planning, this is one of her goals. Let's see whether what she's planned to do is going to be sufficient. So Pam does, or she requests that someone help her with this calculation. She contacts an advisor, and she plays around with the calculations a bit. She makes a few assumptions, which is always required for these things, and she starts with a retirement age of 65, and she takes into consideration her current compulsory retirement contributions, which is 750 Rand, and then also her additional 500 Rand that she's decided to allocate towards long-term savings. And then she starts off by selecting her current income requirement. So the 12,000 Rand, of course, she's not going to earn 12,000 Rand by the time she's 60 or 50. But to start small, start at the current levels and adjust the plan going forward is a realistic approach to starting to plan for retirement. So she starts at the 12,000 Rand, and then she plays around with the calculations, and she notices that if she contributes what she's planning to contribute, but she increases the debit orders by 10% every year. So in other words, she loads a 10% escalation to the contributions, then she's going to be 99.4% on track. The trick here is going to be to increase her contributions with 10% per year, because this is more than inflation. But she knows about this, and this is a conscious decision that she's going to make, and she's really going to focus on doing this because this is what's going to be needed to reach her goals. And the idea really is to adjust this and to do this calculation every year or every few years to just see where she's at with her planning and what adjustments are needed. The next goal that she has is to get a place of her own. She finds this lovely little flat in Queenswood for 6,000 Rand a month, and her flatmate that she ends up finding is one of her colleagues who she heard is also looking for a flatmate. So yeah, they decide to rent this place and share the costs involved. In terms of buying a car, Pam realizes that she's not going to be able to get the shiny SUV that she would have wanted. She's going to have to compromise a little bit, and she realizes that it's actually realistic. Her budget is realistic. If she's willing to just drive a simple car, she's actually going to be able to meet all her goals. So she decides on this little car with an installment sale amount of 1,100 Rand a month, and this is under her budget, making provision for anything any further unforeseen events. Perhaps interest rates increase, perhaps she can save a little bit extra towards her emergency fund, but the extra buffer really does give her the peace of mind. So she decides to opt for this little 2015 Chevy Spark.
Buying a car is often one of the first significant financial transactions that we enter into, so it's important to understand some of the concepts and pitfalls associated with these transactions. So firstly, beware of balloon payments. Balloon payments, avoid them at all costs. This is something that often comes as a surprise to people who don't understand the transaction that they had entered into. So for balloon payments, what it is you enter into an agreement with the bank that provides the financing for the vehicle that you're going to end up paying off just a part of the capital amount during the course of the contract term, which of course helps you with the affordability. It does reduce the monthly installment to an extent, and then you agree to pay a chunk of it as a lump sum at the end of the contract term. So this is a problem for several reasons, except for not understanding the transaction and being surprised by it at the end. There are two options available to you in terms of managing a balloon payment. Firstly, the obvious one would be to settle the outstanding amount at the end of the term as a lump sum. This has a problem is a problem in the sense that you, in many cases, didn't plan for this, so you end up having to redirect some of the other funds from other financial goals meant to go elsewhere. You end up redirecting towards your settling the car, which takes away from your other goals ultimately. The other option would be to refinance the outstanding amount. So you reach the end of the loan agreement, and then when you have to pay off that outstanding capital amount, you apply for financing to refinance that amount, which is a problem if you assume that that's what you're going to be doing, because often, especially with second-hand cars where the value does reduce significantly over time and there might not be sufficient security left for the bank, where they wouldn't necessarily guarantee that they can provide you with refinancing. So it is often a problem. You might not qualify, but on the other hand, you might also qualify for financing, but they might provide or offer very unfavorable terms. You might have a terrible interest rate, very high interest rates, or you would have to be required to settle the amount in a shorter period of time than you expected. So paying off a new loan is a bad idea, but also you end up paying interest double, which is never a good idea. The next point is buy within your means. It's very important to buy within your means, especially with Pam. She's at a phase in her life where she needs to, from a financial point of view, go from nothing to something. If you end up buying or living out of this comfort zone, then you will end up having to incur debt, which can easily snowball with you. And this might actually be very detrimental to your credit record and to taking control of your finances going forward. Remember additional costs, budget for it. There's always insurance, services, maintenance. This is something that is significant and definitely needs to be planned for. Then remember, a car is not a growth asset. You're not going to sell it at a profit. It does lose value over time. And this is also one of the problems with the balloon payments, is there might not be any security left that the bank would consider as sufficient. And then always plan for possible interest rates. We currently live in an environment where the interest rates have gone up significantly. So people with outstanding debts has suffered. So whenever you plan to incur any debt, budget for a possible interest rate of perhaps a 200 basis point. This is a good rule of thumb. And just make sure that in the event that the interest do increase, or the interest rate do increase, then you can still absorb the additional pressure to the cash flow. And then remember, this is not considered good debt. It is expensive debt. It is a high interest rate. It's higher, or considered high in comparison to a property, for example, which is seen as good debt. So always avoid debts, bad debt where you can. Beware of big ticket items such as houses and cars. These are considered, or generally quite expensive, but also other than that, they do tend to be associated with a specific term. You end up financing them over a certain term. So it comes down to the fact that if you make a mistake, it sets you back for quite some time. The commitment lasts with you for a while, for several years, and it's not just a once-off. It also tends to be those items that you end up buying above your means, trying to live up to the Joneses, so that's never a good idea. Minimize subscription services and streaming sites. Some people might not agree with me, but all of these subscription services, they are luxuries, and it can really help you if you end up saving on those items. Then rethink the cell phone upgrade. I think many of the people many people can relate that people consider these upgrades as a given. It's normal. And you end up saving hundreds of rands if you just skip the upgrade, if your cell phone obviously is still in a working order, but you end up saving significantly if you skip the upgrade. Then stay away from retail accounts. I know that many people won't heed my warning and won't listen to me. However, if you do end up applying for clothing accounts, retail accounts, then just be selective. Have a look at the terms and conditions. Often some of these accounts do offer, say, a 6-month interest-free period, which might help, and often other ones have costs associated with them. Sometimes you pay a certain amount towards insurance for it, so they are costly, some of them more than others. So just be selective when you select your account. And then try carpooling if necessary, or if possible to reduce some of the fuel costs. It's not always possible. In Pam's case, she can. This is realistic because she does live with one of her colleagues. It does mean she's going to have to plan a little bit more because she does see clients from time to time, so she's going to have to manage her meetings, her appointments, but it is definitely going to save her some fuel costs in the longer term. And then be energy efficient. I don't think anyone needs more tips on this. I think we all are very much aware of how we can save energy. We do live in a time when we experience significant power crises or energy crises. So just have a look. There's a lot of information available as to how you can save on electricity. And then shop around for sales and compare the prices. The big thing about this is it comes down to conscious spending and thinking about what you buy, and not just spending irrationally and just putting things in the basket and buying. So whenever you are forced to sit and think about something, you end up doing it properly, or possibly doing it properly. So yeah, shop around and focus on conscious buying. I'm going to run through these a little bit quicker in the interest of time, but I do want to stand still at the medical aids. Sometimes one has a comprehensive medical insurance or medical aid, and you end up being young and healthy. And it's good to speak to a medical aid professional, an advisor that can guide you through the various options. But in many cases, having a hospital plan in conjunction with a gap cover might be more than sufficient given your circumstances, and you might be able to save quite a lot by doing that. And then limit bank charges where you can. There are many bank accounts out there offering very sophisticated services, but not all of us need the sophisticated bank accounts. So find an account that offers services, or that has an offering that speaks to your own unique needs. And by doing that, you can save quite significantly. And then consider online shopping. This is something in today's day and age that's become natural to us, which is fantastic because it's easy to keep track of your spending. You have your virtual basket, and you can easily see the rands and cents add up. In terms or in comparison to shopping in the shops, where you just add things in the basket and only find out at payment time what you end up incurring. This is definitely fantastic. It's a lot easier to manage those impulsive buys that you often make.
Long-term insurance, make sure that you understand what you have. Often people have group cover, and they perhaps have a policy on the side as well. So make sure that you're paying your premiums for insurance that you can actually claim for. You can't. You shouldn't be overinsured, so just make sure that you know what you have and what it entails, and that you're not overinsured. And then in terms of loyalty programs, if you're not using it, cancel it, because often you end up paying for these loyalty programs. And then review your short-term insurance. That's now your car and your house. As an example, make sure that the amount insured is correct and that you're not overinsured there as well. Very handy quote. Don't spend money you haven't earned to buy things you don't want to impress people that you don't like.
So what feels like a blink of the eye, 10 years have gone by and many things have changed in that time. So Pam is in a good space. She's in a good place financially. She has made significant, very good decisions from a financial point of view over the last 10 years. And she really has reaped the rewards of her discipline. Not only is she in a good space financially, she has since gotten married to Jim. And together they also have a little girl. So circumstances have changed. They now have a joint income to consider. Of course, Jim has a few months left before his car will be paid off. He opted for the big flashy car a few years ago, where Pam ended up buying the small Chevy Spark. And then Pam's car, obviously it's been paid off for a while now, but she is itching for an upgrade. And then together they have accumulated an emergency fund of around about 80,000 Rand. An emergency fund is a bit of a grey area. Some people say you need at least 3 months worth of expenses in that account, which is a very good rule of thumb. In their case, they're comfortable with the 80,000 Rand that they have. And then they've decided to have a separate savings account for family-related expenses and emergencies. So they have an amount of 50,000 Rand in a separate account. They believe from a psychological point of view, they prefer to split their own emergency provision with this 50,000 Rand. And then they have been focused on saving towards buying a property. So they have around 300,000 Rand or between the two of them, and that is earmarked to purchasing a property sometime in the future.
Given the fact that they now have a joint income, they opted to budget together. Of course, there's no right or wrong way of doing this. Many married couples end up having separate budgets, which if that works for them, then it's perfectly fine. Jim and Pam decided that they do have mutual goals. They work towards the same goals and dreams. And if they dream together, it makes sense to them to plan together and to budget together. So they opted for a joint budget. Furthermore, in terms of a joint budget, there's no right and wrong in terms of splitting the expenses. They earn exactly the same amount of money. They decided that they're going to split certain of the expenses so that it's fair, but then they also have their own personal goals that they're addressing. But something that you'll see from the budget, if you have a look, important is now there's many other expenses that can be budgeted for that didn't previously feature. So at this point, they now have the means and the luxury really to start saving for things that are more in the want category than in the needs, as we saw with her 10 years ago. So now they save 3,000 Rand each per month towards holidays, which is something that they really add or attach value to. And then, of course, they can afford now to have their fiber and their streaming services. They also have an entertainment budget. They do like entertaining, so now they can specifically budget towards that. And then, of course, once again, they need to live. So both of them have a spending budget now, pure spending, and a separate clothing account, clothing budget, and then a miscellaneous category, which basically constitutes any expenses that don't fall into any of the other boxes each month. So they're at a stage in their lives where they can really start focusing on things that matter to them. Dreams that they might have. And then in terms of some of the other necessary expenses, they've split it so that it's fair. You'll see there the emergency fund, they're not contributing towards that anymore because they feel that they are happy with the 80,000 Rand that they have. And then of course they have been saving 2,000 Rand each per month towards the house deposit. And then you'll notice as well that the retirement savings, Jim's retirement saving contribution is slightly less than Pam's. And at the end of the day, there's no right or wrong. Everyone has their own priorities. And Jim has decided to opt for the shiny car years ago. You'll notice here he's contributing or paying 8,000 Rand towards towards paying off his car, whereas Pam has now felt how it feels to have a paid off car. But yes, he of course opted for the fancy car, but you can see in the retirement contributions, he's not managing to save as much as Pam can at this point. And of course, in terms of the budget, he doesn't have the same surplus that Pam has. So yes, Pam's diligence and her discipline has really paid off in terms of her cash flow now years later. So when it comes to dreams, Stanley did promise that there's going to be a time for dreams, and Jim really does think that time is now. He has been dreaming about owning a house. He wants to provide for his family, and he's done renting. He doesn't want to ask the landlord whenever he paints something. He wants to be a homeowner. And on the other hand, Pam also has dreams, and she feels that she's been driving her little car for way too long, and now is her time to also have that upgrade. She deserves that upgrade now years later. So these are their dreams, and now they're at the phase or at a stage where they can really start focusing and addressing the dreams as well, because all the basic needs have been taken care of, and they are comfortably under control at this point. So in terms of buying a property, there are many financial implications. So Jim needs to go through these motions. So firstly, buying a house within your budget. And there's a lot of additional costs, so you need to sit and work out your affordability, do the math, and look for a property that's within your budget. Just as we mentioned with purchasing the car earlier, make sure that you can afford possible interest rate hikes. The one thing with a house that's a bit different than with a car is the term of the agreement. A home loan is 20 to 30 years, unless you pay it off sooner. But the commitment is a long time. It's a lot longer than with a normal installment sale. Then make sure you can afford all the once-off costs associated with a purchase. So this is costs like the actual move, renovations and furniture and curtains. All of these costs are costs that I think when people do their budgets in the beginning, they they don't necessarily plan for these because they don't see it as a priority or as a must-have. They think they're gonna skip these, but they do end up, in many cases or in most cases, they do end up still incurring these expenses, but they didn't plan for it. So if you can plan for these things, it is something that is in all likelihood gonna happen. And then remember to plan for homeowners insurance. If you were renting previously, the homeowners insurance would have likely been taken out by the owner of the property. But being a homeowner, remember your homeowners insurance. If you buy a sectional title property, the homeowners insurance will be included in your levies. You still need to insure your household goods if you want to, which you should, but the bank might require you to have homeowners insurance if you buy a standalone property. So consider that it is often a significant expense as well. And then consider any additional costs that can be of an ongoing nature. If you lived in a sectional title property and they came and they mowed the lawn, they worked in the garden, fixed everything up every week. Now you perhaps live in a standalone property and you end up having to pay extra for garden services and maybe security, possibly increased travel costs. Consider that and incorporate that into your monthly budget, because the cost involved with a property isn't only once off. There might be ongoing costs to budget for. Then in terms of the joint budget and Jim's plan to buy a property, let's see how realistic it is, and let's help Jim out in terms of the affordability. So of course there are a few obvious costs that's going to fall away. If they end up purchasing a property, the rent will fall away. Then there's the car installment, because he's going to wait until he settles his vehicle. So there's going to be 8,000 Rand. And then of course there's the 2,000 Rand each that they currently save towards a deposit. So that gives us an amount of 21,000 Rand, which he can afford each month when he's now looking for a property. But of course, a monthly cost is not the only cost involved. There are many once-off costs associated with buying a house, and this is something that's very important to consider. So when you purchase a property, especially when you register a bond and you get financing for the property, there's going to be two legs to the transaction. You have your transfer leg, and then you have your bond leg. So on the transfer side, there's going to be transfer costs involved. There are many calculators such as these available on the internet. Many banks and attorney firms have calculators that you can play around with. Jim has gone and he's looked around and he's found a property which really serves their needs. It's just the right size, and you'll see now it's very much within their means. So the purchase price of this property that he's looking into buying is 1.8 million. So just have a look at the cost involved with the purchase price of 1.8 million. This is purely an estimate, but there's your transfer duty, which is 36,750, which is based on a sliding scale. But then there are all these other costs that add up, and the total transfer costs end up being just under 75,000 Rand. So this is a significant cost. Few people can just pay it from savings without planning for it. So it's very important to budget for this.
So of course the other side of the transaction is the bond side. That is where you have to apply for financing. Jim has 200,000 Rand that he's willing to put down as a deposit. That leaves him with 100,000 Rand remaining for costs. That is now the 300 that adds up to the 300 Rand that they set, 300,000 that they set aside for the property purchase. So if they put down a 200,000 Rand deposit, they need to apply for financing for 1.6, buying the 1.8 house. It's 1.6 remaining, and as you can see here, the total bond costs are quite significant. It's 35,000 Rand, once again just an estimate, and the bond attorney fees, it's one of the most expensive ones, and then you'll see all sorts of little costs that people aren't always aware of, and you end up not necessarily planning or budgeting for these costs. So it's very important to understand how the transaction works. And just a quick reminder that bond attorneys are usually appointed by the banks, and the transferring attorneys are usually appointed by the seller or often the estate agent if there is one involved with the transaction. So in this case, the total cost comes in at 111,000 Rand. In Jim's case, he realizes that yes, it's 11,000 Rand above his budget, but if he just waits, say, 2 months after he's settled his car, he's going to be able to absorb the additional 11,000 Rand. So this is an option he's very comfortable with, and he's definitely gonna opt for this one.
And then now that the once-off costs are sorted, we need to have a look at the ongoing, the cost involved with the property and see whether they can afford the payment amount monthly. So if we consider a credit amount of 1.6 million, a bond amount of 1.6 million, and we assume an interest rate of prime minus 0.5%, and we take the standard 20-year term, it comes down to a total monthly amount of around 14,653. It is, though, important to consider additional costs, as we've mentioned, and Jim has calculated that the property that he's looking at will have around 5,000 Rand extra per month, which needs to be budgeted for as well, and needs to also come out of the 21,000 that they've set aside, or that's going to become available. So that very comfortably comes in below that amount. So this is definitely an affordable scenario given what they can, their monthly income and surplus at this point. So as we've mentioned, we need to make sure that in the event the interest rates increase, rule of thumb 200 basis points, will Jim and Pam be able to afford and absorb the extra payment or the extra cost? So if we relook at the calculation based on the increased interest rates, then the monthly cost equates to 16,788 Rand. So if we consider the monthly costs that's associated with a new property, that's slightly over budget. So Jim decides that it's not the end of the world. It's not going to break the bank when you consider he does have his miscellaneous budgeted line item as well as some of his own spending. He is comfortable with this scenario, and he's comfortable to proceed with this.
So another option that he's heard of is stretching the payment term over 30 years. He's not considering this, but he's just curious, so he does the calculation based on these terms, and he finds that this definitely helps with the affordability. The total monthly cost on the payment comes down to 13,000 Rand, which would definitely help with the affordability. However, as you can see here, the interest that you end up paying is 3.1 million. It's more than 1 million more than the first scenario that we looked at. So the total loan amount that he ends up having to pay is 4.7 million. So you buy a house for 1.8, you finance 1.6, and you end up paying 4.7 million Rand just because of the term that you've stretched the loan over. So shop around, do your research, find a place that's within your budget that you can afford. Some banks offer pre-approvals, which gives you an indication of the amount of debt that you might be able to qualify for. So that does help you in terms of knowing in what price range to go shop around. And then just understand the way you're going to be structuring the agreement. Often people want to register the ownership in both you and your spouse's name, but you only want to have the debt in your own name. So if that is the case, just be wary of the fact that your spouse might have to sign surety to the bank, in which case her or his finances will also be considered, and then of course they would need to offer consent to that. And then make an offer to purchase, which is really where you offer your specified amount for the property. It's important to understand the importance of this document from a practical point of view. This is just a 2 or 3 page document, usually a template that the estate agents have. but it's often very much underestimated how important this is, because this is your chance to specify any requirements that you might have before the bond registers later on. So if there's a wall that you need rebuilt, this is where you're going to specify it. If you need a copy of the building plans, this is where you're going to specify it. So this is your one chance to have requirements like that. So of course the sellers need to accept your terms, but assuming they do, then you take the signed offer to purchase and you apply for financing through the banks. You can either make use of a bond originator to shop around for good interest rates on your behalf, or you can go directly to the banks and apply yourself. We've spoken about the implications of structuring the agreement, and then the approval. If the bank is happy with the security and your affordability, they might approve the agreement, and then a lot of work starts behind the scenes before registration takes place. So then everyone, the banks and the attorneys, they cross their T's and dot their I's in the background, and then once they're happy with everything, they will offer, the bank will provide the go-ahead to register, and at that point the ownership changes hands and the money really flows. What's important is the timeline as well between the approval and the registration process. Often, if it's a very simple transaction, it can take, say, a month, but it can often be stretched out over several months if there's some kind of a hold-up. So in the event that that happens and it is a little bit longer than you expected, just make sure that you understand what the implications are from an occupational rent point of view. So the occupational rent would have been specified in the offer to purchase, and that indicates who's going to be liable to pay rent if you end up living in the other person's house. So if you ended up agreeing on moving in at a certain time, but at that point the bond hasn't registered yet, and is obviously then still in the name of the sellers, then you will be liable to pay occupational rent towards to the current owners, which is the sellers. But of course, if you end up moving in and it's after it's registered in your name and the current sellers have been living in your property for a while, then you are entitled to receiving the occupational rent. So just understand that as well.
So Pam also has dreams. We've now had a look at Jim's dreams, but let's see how we can help Pam. So Pam, she is now dreaming about this new car that keeps popping up on all the billboards. All the moms have it. When she goes to school and drops off her little girl, everyone has these big mom cars, and she would really love to upgrade to one of these. So let's go have a look at Pam's budget and see whether she can afford this. So when you look at the joint budget, some of the items have already been excluded. The green ones, that's now for the property, but let's see whether there are any other funds to save or to spare. So she already has a surplus each month of 7,100 Rand. So easily she can afford a car if it's going to cost her 7,100 Rand. But she has a sneaky suspicion that it might be slightly more than that. So she's considering her options in terms of perhaps redirecting some of the funds elsewhere. So she has a look and she sees that she has been contributing quite a substantial amount towards her retirement or her retirement savings, and she's willing to redirect 3,000 Rand per month if she has to. So at least now she can go look around, shop around for a car, and she can afford 10,100 Rand per month. Pam starts off with considering her options in terms of buying brand new. She has a look at a brand new option where she puts down a 10,000 Rand deposit. The price is 580,000 Rand, and she can get 10,000 Rand for her for the trade-in for her car. And she's considering initially zero balloon payment. She just wants to see the affordability, and she sees that it's going to cost her 11,100 Rand for a brand new car without a balloon payment. So this is above her means. This is more than she budgeted for, so this is not an option that she's going to be considering further. So the next one she has a look at is if she opts for the new car, but she selects a 30% balloon payment. And now we can see the implications of a balloon payment, it makes the car a lot more affordable. So now the cost comes in at 9,400, or let's say 9,500 Rand per month. But it does mean that at the end of the 72-month term, she's going to have to pay a lump sum of 174,000 Rand towards the finance house, or she's going to have to refinance the car at that point. Of course, there's a second or a third option that she can consider, and that is to buy used. And she shops around and she sees that there are fantastic options. There's this 2018 model, only 45,000 kilometers on the clock, and the price is significantly lower at 364,000. If she considers a slightly higher interest rate because she realizes this is a second-hand car, so perhaps the terms won't be as favorable as a brand new car. And now she sees the monthly amount actually comes down to 7,079, which is right in her means. It's under the amount that she budgeted for, and this is definitely, being the disciplined person that Pam is, this to her is an obvious choice. She's definitely opting for the second-hand option. Let's have a look at some of the opportunity cost involved with some of the options we looked at. Of course, there are many, but I'm just going to look at a few of them. If Pam opted to pay the 7,100 surplus that she currently has, if she decided to rather pay that into the new bond that they have, how would it impact the picture? So here we see if she ends up paying that into the bond, she ends up they end up paying the house off or the bond off in half the time, basically, and they end up saving 1.1 million Rand, which is a significant saving. And of course, with any decisions like this, there's no right or wrong. You end up having to just weigh up your options and making a conscious decision and an informed decision. And this is just, if she ends up doing this, it's perfectly fine. If she ended up buying the car, that's also fine, as long as it's an informed decision. It's all good. The next opportunity cost that we're going to look at is if she ends up, this one has a few assumptions. So if she ends up opting for the new one with the balloon payments, and she ends up, we assume that she has the balloon payments available at the end. So we're just going to have a look at the monthly payments. But she redirects the shortfall, the extra that she's going to have to, basically the amount that she's going to have to borrow from her long-term savings. That's about 2,400 Rand. If she ends up doing that, and we have a look at what that 2,400 Rand could have meant for her in terms of her retirement one day, and we do the calculation, that almost 2,400 Rand could have grown to around 226,000 in the installment sale time, that's 6 years. And if you project that further to retirement, then it could have translated into a monthly income at retirement of around 10,000 Rand per month, which, if you bring it back to today's money terms, it's around 1,288 Rand per month, which I think most of us will agree is a substantial amount of income, and I think everyone can do with an extra 1,200 Rand a month, so it really is significant. Of course, the previous scenario goes hand in hand with the balloon payment, so a third option that we're going to look at, or example that we're going to look at, is if we end up she ends up not refinancing the balloon payments, but rather opting to take that from other sources, perhaps also long-term funds. So the likelihood, unfortunately, is that she's going to end up refinancing. In many cases that is the case, but let's assume that she withdraws the funds from other savings and settles the amount as a lump sum. So we're saying we assume that she's going to withdraw it from her long-term savings, and once again projecting this amount to retirement, we see that it could have meant an income of 8,000 Rand at retirement per month, which in today's money terms equates to around about R1,000 per month, which, just like the previous example, is quite substantial, and I think everyone can do with another R1,000 a month. It is significant, especially if you consider that these two options really go hand in hand. So it really is both these costs. So it's more than R2,000 a month that you can expect if you consider both these opportunity costs. Just a few general tips, not going to go through most of them, but have a look. But have a will and have a file with important information that your beneficiaries might need if something happens to you. That is the one point that we didn't discuss today. Very important, and a large topic, large enough for a whole new session. And then go through your bank statements from time to time. Make sure that you understand everything that happens. Often something creeps in there which you forgot about or that you weren't aware of. So interesting things can be picked up by just being aware of what happens on your financial or on your bank accounts. Something to mention here is review your financial position regularly. Many of the things we discussed today, it requires constant adjustments. Every year you need to sit and do some of these calculations and the budgeting. So it's not a static type of thing. It moves. It's a living thing almost. So do the calculations and adjust where necessary. And partner with your financial advisor. Make them a partner in your financial situation and your financial planning. You're definitely gonna benefit from that. So today Pam is liberated and she's not held hostage by her financial woes. Her discipline has allowed her to live her life according to her own terms, and I think we should all strive to be more like Pam. Thank you very much. Bye-bye.